investing can feel like navigating a maze, especially with headlines screaming about tariffs and trade wars. But don't worry, we're here to break it down. Today, we're tackling a topic that's vital to your financial well-being: tariffs. Tariffs are taxes on goods traded between countries, impacting prices of everyday items and your investments. Understanding tariffs is like having a secret weapon in your investing arsenal. Think of the global economy as a giant game of chess. Each country makes moves to protect its own interests, and sometimes those moves involve tariffs. These tariffs can disrupt the flow of goods, making it more expensive for companies to do business. By understanding how tariffs work and making strategic decisions, you can protect your investments and even find opportunities for growth. We'll uncover the ways tariffs impact different industries and explore how you can safeguard your portfolio. Imagine you're a business owner who wants to sell your products in another country, but there's a catch. That other country wants to protect its own businesses and workers. So they slap a tariff on your product, making it more expensive for consumers in that country to buy from you. Tariffs come in different shapes and sizes, like a 10% tariff on imported steel or $50 per ton of imported lumber. Their goal is to make imported goods more expensive and encourage consumers to buy domestically produced alternatives. Governments use tariffs as tools to shape trade policies and protect their own interests. One of the primary reasons governments impose tariffs is to protect domestic industries. If a flood of cheap imports threatens to put local manufacturers out of business, a government might impose tariffs to level the playing field. Beyond protecting their own industries, governments also use tariffs as bargaining chips in international negotiations. This game of tariff threats and counter-threats can be a high-stakes poker game, with each side trying to secure favorable trade deals. The outcome of these negotiations can have significant implications for businesses and investors. The global economy is like an intricate web, with each country's economy connected to countless others through trade. When one country throws a tariff into this web, it can send ripples throughout the entire system. A tariff imposed by one country can disrupt supply chains, delay production, raise costs, and hurt bottom lines. Even if you don't directly invest in companies involved in international trade, your portfolio can still be affected. Understanding these ripple effects is essential for investors who want to make informed decisions about their portfolios. We live in a world more interconnected than ever before. Products we use daily are often the result of a global assembly line. This intricate web of trade, while efficient, is also incredibly sensitive to disruptions. Imagine a giant spider web. Each strand represents a trade route. A single tariff can make the entire web tremble. Tariffs can cause a chain reaction, impacting production costs, prices, demand, and local economies. For investors, this interconnectedness presents both opportunity and risk. When trade flows smoothly, businesses flourish and markets thrive. But throw in the unpredictable nature of tariffs and things can get bumpy. The stock market hates uncertainty and craves stability. This lack of consistency makes it incredibly difficult for businesses to plan for the long term and for investors to strategize their moves. Understanding tariffs and their potential impact is crucial for anyone looking to protect and grow their wealth. Let's take a closer look at how this tariff drama plays out in the real world. The automotive industry, with its complex global supply chains, is a prime example. Car manufacturers rely on a delicate balance of sourcing parts from various countries. But when tariffs enter the picture, this carefully crafted system can crumble. These disruptions ripple through the entire supply chain, causing delays, increasing costs, and ultimately impacting the price consumers pay for their vehicles. The aerospace industry, too, isn't immune to the tariff bug, with companies like Boeing navigating rising costs and complex trade negotiations. Let's zoom in on an industry that's become practically inseparable from our lives' technology. Your smartphone is a mini marvel of globalization, with components crafted in different corners of the world. Imagine tariffs being thrown into this intricate dance, causing the cost of components to skyrocket. The smartphone manufacturer faces a dilemma: absorb the increased cost or pass it on to consumers. As investors, we feel the impact as the company's stock price dips on news of shrinking profits or slowing demand. Tariffs don't just play out on a global stage. They also trickle down to us, the consumers. They influence the prices of everyday items, from washing machines to construction materials. As the cost of these essential goods rises, consumers are left with less disposable income. This decrease in consumer confidence and spending can send shockwaves through various industries. It's a domino effect, and tariffs are often the unseen hand setting it in motion. Tariffs are not a new invention. They've been a tool of economic policy for centuries. What's different today is the sheer scale and interconnectedness of the global economy. In the past, a tariff might have primarily affected a handful of industries within a particular region. Today, with global supply chains spanning continents, the impact of a single tariff can be felt far and wide. The good news is that we're not powerless in the face of these tariff storms. Savvy investors can take steps to weather the uncertainty and come out stronger on the other side. It's all about building a portfolio that's resilient, adaptable, and capable of navigating the choppy waters of global trade disputes. A resilient investment portfolio is built on a foundation of solid companies, diversified across different sectors and geographies. By focusing on quality investments and maintaining a long-term perspective, you can ride out the storms and emerge with your financial well-being intact. One of the most powerful tools in an investor's arsenal is diversification. Instead of putting all your money into one company, one industry, or even one country, you spread your investments around. This reduces the impact any single event can have on your overall portfolio. If you drop a basket with all your eggs in one go, you'll end up with a scrambled mess. But if you divide those eggs into several baskets, even if you stumble with one, the others are more likely to remain intact. Diversification provides a buffer against losses and keeps your overall investment strategy on track. Section 3. Beyond diversification. Unearthing tariff-resistant investments. Diversification is key, but we can go further. Tariff changes can trip up investors. What if we find tariff-resistant investments? Companies resilient to tariff impacts are key. Let's identify and include them in our portfolios. Section 1. Taking action. Safeguarding your investments in a tariff-prone world. We've covered a lot of ground, haven't we? We've demystified tariffs and explored their effects on the global economy. But knowledge without action is like a car without an engine. Now, we shift gears from understanding to doing. We're aiming to become more informed, strategic investors. Empower yourself with knowledge to navigate this complex landscape. Let's dive into practical steps to protect our investments. We're talking about common sense strategies and long-term thinking. You have more control than you might think. Take charge of your investments and make informed decisions. Section 2. Building your Tariff Toolkit. Strategies for the savvy investor. Think of yourself as a financial detective piecing together clues to build a resilient portfolio. Stay informed about global trade developments and understand how companies are positioned. Identify reputable sources of information for valuable insights. Scrutinize your existing investments and assess tariff risks. Diversify your portfolio to mitigate the impact of tariffs. Section 3. The long game. Patience and perspective in the face of uncertainty. Patience is a secret weapon in investing. Market fluctuations are natural. Investing is a long game. Like planting a tree, it takes time. Nurture it, and it will bear fruit. Focus on fundamentals, not short-term swings. Navigating the tariff seas with confidence. Tariffs impact your portfolio, wallet, and supermarket prices. You're not a passive bystander in global trade. Arm yourself with knowledge and adjust your strategy. Knowledge is power in investing. Use your understanding of tariffs as a compass. Tariffs are often temporary. Avoid knee-jerk reactions. Build a resilient, diversified portfolio. Diversification is your life jacket. It keeps your investments afloat. Section 2. The opportunity within. Turning challenges into stepping stones. Is there a silver lining to all this tariff talk? Yes, within every challenge lies an opportunity. Tariffs can create uncertainty, but also present unique opportunities for savvy investors. Think of it this way. When a storm disrupts a forest, it often clears the way for new growth. Similarly, economic uncertainty can create opportunities for prepared, adaptable investors.